Since Monday, markets have been getting ready for the crucial event, the policy meeting of the Federal Open Market Committee scheduled for Wednesday. In anticipation of this event, the single European currency has been gaining ground versus the greenback. The reason is that the US Central Bank is widely expected to announce the first rate cut. Analysts admit the scenario that after the first rate cut in several years, the US dollar could still rise if suddenly the American regulator is not aggressive enough and lowers the funds rate by only 25 basis points. But until then, the US dollar will be under pressure and gradually lose its value. The US dollar index, which measures the greenback strength against the basket of 6 major currencies, is preparing to challenge a one-year low of 100.50 points. Market participants rushed to actively sell the US dollar after the publication of inflation data for August, which slowed faster than expected and also aimed signs of a weakness in the American labor market. Meanwhile, the euro is taking advantage of the US dollar's weakness and is winning back losses, even though the European Central Bank unexpectedly sharply reduced its rate last week. The euro-dollar pair has resumed its overall bullish trend after a recent downward correction. In the current fundamental conditions, the euro-dollar pair is unlikely to sink below 1.1000, but if the euro settles above 1.1100, on the back of a dollar sell-offs, traders may add long positions on the euro. In this case, the instrument may climb to the recent local high of 1.1200. The alternative scenario suggests a slowdown in the uptrend, so the instrument may decline back to 1.1050. What's going on in the oil market? After several days of growth, oil prices are going through a slight correction but remain at about $72 per barrel. It means that the market is trying to strike a balance. However, from a technical viewpoint, the downtrend is still relevant in the market. For this reason, if the price returns to the $70, a new bearish sequence is possible. As for a full upward correction, the price first has settled above $73. The market is awaiting some reaction from OPEC and its allies in terms of revising oil production quotas. Besides, we should not forget about the upcoming Fed Reserve meeting. The policy decision will also have an impact that will be the most significant in the short term. These expectations naturally have a bearish effect, allowing only modest growth. So over the next couple of days, the oil market is expected to remain stable unless something unexpected occurs. Back to the topic of interest rates. At a time when all major central banks are starting to ease their monetary policies, the Bank of Russia is doing exactly the opposite. On a Friday, the Russian central bank not only announced another rate hike, but also sent a message of a further monetary tightening. The regulator's actions already raised many questions from Russian businesses. Now the barrage of criticism has only intensified. These factors contribute to the weakening of the ruble. Although following the meeting, there are moments when the ruble slightly strengthened, but this is temporary, and the ruble will continue to lose its position in the medium term. It's quite possible that by the end of the trading week, we will see attempts by the dollar-ruble pair to rise above 92. That's all for now. We continue to monitor the developments in the financial markets. Subscribe to the channel and stay up to date with the news. See you soon!